All right, let's catch up with our friend Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. GetRetiredStayRetired.com is his website. Craig, welcome back to the show.
Hey, John, good to be with you. I mean, while there wasn't any big economic data, I feel like we're repeating for the last 4 weeks. 4 weeks in a row, Thursday and Friday are negative trading days, but Monday has always been sunshine and roses for the past month. We'll see if that comes about after the weekend.
I suppose that's just a coincidence. There's no rhythm to that, is there?
Well, there's some rhythm. I mean, no one knows for sure, but I think it's probably not the investors. I think it's probably all the traders wanting to close out positions and not own anything going into the weekend when there's uncertainty, and then everybody comes back and bids up stocks. And then we all trade based on the posts on Truth Social, and I'm not sure if anybody knows what's coming out of Iran is reliable enough, given they've got fractured leadership.
So guys are looking at the ticker tape less and at Truth Social more?
I think everyone's paying attention to both. I mean, let's remember, at the end of the day, if you said, what are people paying attention to? This started about one thing, and it remains one thing. It is an oil shock, an exogenous oil shock, leading to an inflation spike, but I haven't yet seen any economic data to tell me the jobs market's rolled over. I haven't had any earnings data to tell me companies are no longer profitable. And I certainly haven't seen any economic data, GDP or the likes, to tell me we're heading into a recession. So I think this is a asset allocator's dream. It's an opportunity to embrace volatility and make long-term moves to help people thrive in retirement.
Yeah, so shock makes it sound like something that comes and then goes. But I guess if you get shocked long enough, you do lasting damage. And I think there are some maybe nabobs of negativity out there, but there's some people that say it's going to be a while before we recover from this shock, Craig.
You know, I think it could be a while before we recover from the shock, but something I was looking at last night in preparing for your radio show is I was looking at the spread between WTI, that's West Texas crude, Brent crude, and then some of the other ways that crude oil is priced, like in Dubai and other places. And there was a magnificent spread, as much as $80 a barrel at one point in time between WTI and Dubai. And just know, John, that spread has been narrowing. So someone somewhere out there must think that the strait is eventually going to get opened. You're just hoping what I'm hoping, which is I don't have oil being the dominated headline all through Memorial Day and into the 4th of July, because if it's still here through the 4th of July, this will have been too long.
Craig Bolanos is talking to us somewhat optimistically, I would say. Right, Craig? You feel that while this is a shock to the system, the spike in oil and fuel prices, you don't think that this is going to be with us for a real long time?
I don't think it's going to be here forever. I mean, we're not in control of the entirety of the situation in the same way we had control over the tariff tantrum last year, this same seasonality. But, John, there remains a plausible scenario where the geopolitical tensions subside rapidly, the oil prices correct from current levels, and the labor market, the jobs market, stays resilient in the coming quarters. But you're right, the longer this drags out, the more narrow that path comes, and that more narrow path creates risk to both sides of the Federal Reserve's dual mandate, which is keeping prices moderate and maximizing employment. But yes, stay optimistic. I think that's what the numbers currently show.
You think the Fed is going to react to any of this?
I think the Fed is doing the right thing. Remember, they always are data dependent. And when you're data dependent, you're not anticipatory. Sure, you run the risk of being late. Sure, you run the risk of not being preemptive. But a data dependent process makes it more systematic and repeatable. So I'm very happy with what they're doing. But I do expect that once this passes, we're still going to deal with this large increase in productivity that artificial intelligence is creating, which is going to continue to create some job loss. And I do expect easing at the tail end of the year, coming in the form of rate cuts in Q4 to help protect the job market in America.
Okay, because what the Fed is doing now is nothing. And there's some speculation that they might be inclined to raise it a quarter point if inflation lingers. What's your thought about that?
Lindholm Roofing has appointments available now to provide you a complete roofing, siding, gutter, and tuck pointing inspection. Call 773-283-7675 or lindholmroofing.com. Tell them that Lou sent you. Lindholm Roofing, their family has your family covered.
My thought is I'm paying attention to all of those things as we should. You know, I just wrote a quick piece the other day about the break-even rate on tips, John. Those are those Treasury inflation protection securities, and you and I have referred to sometimes that the smart money is in the bond market, the fast money is in the stock market, and that break-even inflation rate on those tips is at a 3-year high right now, telling me inflation isn't anchored at the 2% the Fed used to want. The 3-year expectation is that inflation's going to stay at 2.66. But you know what, John? 2.66 doesn't seem that bad because I remember a period of time in this country post-World War II where 3% inflation was just fine.
But 2%'s long been the target. And in the Biden administration, however one chooses to characterize the Biden administration's economy, 2% was the number they could never get to. So how important is that goal?
I think the Fed isn't coming out and abandoning that goal. I think the Fed is just no longer talking about that 2% target. The Fed is probably softly conditioning us to all move away from that target. I'm not worried about a second wave of inflation that's going to be reminiscent of the 1970s. I understand the cases that are out there, but I think what we're currently experiencing, absent energy prices, is more of the norm. And that's an inflation expectation that remains in that 2.6 to 3% for consumers as they budget for their retirement longer term.
Microsoft had a bad quarter, didn't they?
Well, you know what? There's been a lot of Mag 7 stocks that have had difficulty, but remember, ever since this war broke out, some of the Mag 7 stocks have been hanging in there okay. They got hurt January through February, but some of the Mag 7 stocks are a reminder to people that when there's shocks that happen across the world, people are going to be looking for growth. I think for some investors, they might have got caught flat-footed. Look at how far consumer staples have dropped. Some other things have dropped. While there's been some strength, believe it or not, since the war in cryptocurrency and some of the technology pieces. But I don't think anybody should bet against the hyperscalers. People shouldn't be betting against those companies that are substantial material for the cloud. And Mr. Softy, Microsoft, would be one of those companies.
I thought, though, we were sort of getting away from the dependence on the Big Seven.
Well, when the Big Seven, right, represent nearly, not quite, but nearly 39% of the market cap for the entire S&P 500, you know, boy, it's going to make sense, right? And, you know, what we saw with Microsoft, since you called them out, is, you know, the software giant doubling down on capital expenditure. Well, AI is not going anywhere. Everybody knows AI isn't going anywhere. So I think, you know, investors shouldn't be shocked that companies are doubling down on their investment into this differentiated technology that is going to transform our entire landscape to the point that we all wake up in the middle of 2027 and we don't even have time to say what happened. It is enhancing the human experience while coming at some social cost at the margins right now.
Amazon's going to spend another $200 billion on AI, right?
All these companies are. I mean, look at some of the announcements we've seen on autonomous vehicles. You know, I haven't been a person who's wanted to jump in an autonomous taxi, but I look at all the big players that are rolling these things out, and I say to myself, you know what? I do believe that when I ask a crowded room, who's a good driver, everybody raises their hands when the answer is everyone's average. And if you go back to driver's ed in high school where it was the 3-second rule, remember, John, the 3-second rule? It takes 265 feet to stop a car traveling at a certain distance. Come on. Reaction times for AI, computers, and technology is superior. And I think people are going to start waking up to that, and we're going to see it in more and more real-life applications, not just all the agents and bots running behind the scenes.
I was thinking about that on the road the other day because everybody was doing about 60 or 70 really close together. And I thought we're supposed to be able to see the sunlight under the front of the car in front of me, which means I have to be back 2 seconds was the rule we had, but nobody, that is not happening out there. And I don't know if I was in a Waymo, would it be backing off or would it be, zipping along real close like everybody else is? I don't know. It
would absolutely, I can't speak for that company, but the general concept is it would be backing off. It would be managing those distances. And think about this, John. There's been all these studies published recently about how much more increased traffic could actually go across our thoroughfares if more and more people were in autonomous vehicles, because you don't have to worry about someone braking too hard and causing a ripple effect miles and miles behind the road. But that's, again, the power of where AI is going to be delivering and changing our society.
We're going to talk more about the car business with Tom Appel after the news. That's all the time I have with you today, Craig. It's always nice to talk to you.
Hey, great to be with you, John.